Good evening, investors, and welcome back with me, Wanizul Islam, right here on KleverStock, and I'll be serving you the closing bell updates for this evening. So, we're going to be kicking it off with the evening updates from Bursa Malaysia. The FBM KLCI rebounded above the 1,600 mark at midday on Friday, but sentiment stayed cautious as investors waited for the US core PCE inflation data for fresh cues on the Federal Reserve's next policy move. Now, at 3 p.m., the benchmark index was up by 7.07 points, or 0.44% at 1,605.54, just shy of its intra-morning high of 1,605.93. Market breadth showed 505 decliners, 419 gainers, and 466 counters unchanged, with total volume at 2.3 billion shares valued at 1.36 billion ringgit. Top gainers included Malayan Cement, rising 42 cents to 7 ringgit 15 cents. Nestle also was up by 38 cents to 96 ringgit 98 cents. Petronas Dagangan higher by 36 cents at 22 ringgit 48 cents. And Kellington Group, they climbed up 18 cents to 5 ringgit 68 cents. Among the decliners, Malaysian Pacific Industries fell by 30 cents to 29 ringgit 30 cents. PPB Group erased by 22 cents to 10 ringgit 10 cents. Fraser and Neve, or FNN, slipped by 18 cents to 27 ringgit 8 cents. And Batu Kawan lost 14 cents to 18 ringgit 78 cents. One of the sharpest moves came from Erica, which faces delisting risks. Its shares plunged 79.17%, or 9.5 cents, to just 2.5 cents, with 29.3 million shares traded. Now, according to Apex Securities, market caution will persist amid weak regional sentiment and the release of US inflation data later today. Domestically, investor interest is expected ahead of the 2026 Malaysian budget announcement on October 10th, with themes such as construction, consumer, and renewable energy stocks in the focus. TA Securities said trading will likely remain range-bound heading into the weekend, with upside capped until investors see the US PCE inflation figures. Now, on the technical front, resistance is pegged at 1,644, the December 2024 high, followed by 1,684 and 1,695, while support levels are at 1,564, 1,527, and 1,490, based on the Fibonacci retracement zones. Now, for some updates on our local economy. Malaysia's reaffirmation of its commitment to the ASEAN Digital Economy Framework Agreement, also known as DEFA, underscores the country's recognition that regional cooperation is essential to unlock the full potential of the digital economy. Ministry of Investment, Trade and Industry Secretary General Dato' Hairil Yahri Yaakob, he stressed that during the business dialogue on ASEAN's Digital Economy 2025, that ASEAN, being one of the fastest growing regions in the world, cannot afford to move in silos. Instead, member states must work together to foster integration, harmonize regulations, build supportive environment that allows digital trade and innovation to thrive. Hairil also highlighted that DEFA is not merely an inspirational framework, but a strategic tool that lays the groundwork for a digitally integrated ASEAN. Now, this framework envisions a region where digital connectivity, e-commerce, data governance, and cross-border payments are streamlined, creating a seamless digital marketplace that transcends national borders. Now, for Malaysia, DEFA is aligned with its national priorities under the New Industrial Master Plan 2030, as well as the Malaysian Digital Initiative, both of which emphasize the digitalization of industries and the growth of high-value digital services. Now, by anchoring itself firmly within DEFA, Malaysia positions itself not only as a beneficiary of ASEAN's digital transformation, but also as a key driver shaping policies that will enhance regional competitiveness. High Rail further stressed that the framework must translate into tangible benefits, meaning it should not remain a paper agreement. Concrete outcomes such as reducing digital trade barriers, ensuring cybersecurity cooperation, and enhancing trust in cross-border data flows are critical. Now, if implemented effectively, DEFA could help ASEAN collectively capture a larger share of the global digital economy, which is projected to be worth trillions by the end of the decade. Now, we're still on local economic news. Kuala Lumpur International Airport, KLIA, set a historic milestone on September 13th when it managed 12,437 passengers in just 1 hour. And that was from the time 7 p.m. to 8 p.m. as holidaymakers packed the terminals during the Hari Malaysia weekend and the start of the school breaks. Terminal 1 processed at least 6,799 passengers, while Terminal 2 handled 5,638 passengers, pushing the airport well above its usual peak hour range of 8,000 to 11,000 travelers. Now, daily traffic hit 191,000 passengers, including 130,000 international and 61,000 domestic travelers. Over the extended holiday stretch from September 12th to 21, KLIA's passenger traffic surged to 1.8 million, surpassing the 1.7 million recorded during the Hari Raya Aidil Fitri peak earlier this year. Now, despite these record volumes, operations remained smooth thanks to upgraded facilities, improved passenger flow systems, and coordinated staff deployment. Malaysia Airports Holdings Berhad MAHB Managing Director Datuk Muhammad Izani Ghani, he said that the achievement underscored KLIA's ability to scale with rising demand. Now, he also emphasized that the focus now is not only on managing current peaks, but also on future-proofing the airport with stronger infrastructure, expanded airline partnerships, and also embedded technology to sustain its position as a global aviation hub. Now, the growth momentum was already visible in August when KLIA handled 5.5 million passengers, 3.9 million international, and 1.6 million domestic. Across MAHB's Malaysian network, passenger traffic rose 2.2% per month to reach 9.1 million. Now, route expansion has also bolstered connectivity. Hong Kong Express launched operations at Subang Airport in August, while Jiangxi Airlines began flights at KLIA. MAHB's international operations mirrored this growth. Its wholly owned Istanbul Sabiha Gökçen International Airport handled around 4.7 million passengers in August, comprising 2.6 million international and 2.1 million domestic travelers, underscoring the group's expanding global footprint. Well done to MAHB and KLIA. Now, let's move on to some news on commodities. Malaysian palm oil futures edged higher on Friday, supported by stronger rival oils in Dalian and firmer crude oil prices. Though weakness in Chicago soy oil kept gains in the check. Now, the benchmark December delivery contract on the Bursa Malaysia Derivatives Exchange added 10 ringgit or 0.23% to 4,449 ringgit per metric ton. That's about $1,054 and 52 cents. For the week, the contract is still up by 0.63% after 2 consecutive weeks of declines. In regional markets, Dalian's most active soy oil rose by 0.27%, while its palm oil contract gained 0.67%. Over in Chicago, soy oil fell by 0.4%. Traders say that palm oil tends to track rival edible oils closely as they compete for global vegetable oil demand. Crude oil prices also edged higher and are set for their steepest weekly rise since early June. Now, that rally follows Ukraine's strikes on Russia's energy facilities, which pushed Moscow to curb fuel exports and brought it close to cutting the crude output. Stronger crude makes palm oil more attractive for use in biodiesel. Meanwhile, the ringgit palm's trading currency weakened 0.14% against the US dollar, making the commodity cheaper for foreign buyers. India grabbed headlines this week with a record purchase of 300,000 metric tons of soy oil from Argentina in just 2 days after Buenos Aires scrapped export taxes on soybeans and other food products. In regulatory news, Indonesia's Supreme Court overturned the acquittals of Wilmar Group and 2 other firms tied to alleged misconduct in securing palm oil export permits in the year 2022. And in Europe, Malaysia's Palm Oil Council welcomed the European Union's move to delay for a second time its anti-deforestation law, saying it gives Brussels more time to iron out implementation concerns. Looking ahead, Reuters technical analyst Wang Tao says that palm oil prices could extend gains into the 4,479 to 4,492 ringgit per metric ton range. And that's based on wave patterns and projection analysis. On a broader market note, Asian shares slipped into early trade after President Donald Trump unveiled a fresh round of tariffs, while stronger than expected US data cooled bets on sharper Federal Reserve rate cuts. And finally, we're going to be wrapping it up with some corporate news updates. Malaysia's proposal to ban the sale of electronic cigarettes and vapes as early as mid-2026 is drawing strong pushback, with critics warning it would fuel illicit trade, undermine investor confidence and cost the government valuable tax revenue. Data Metrics Research and Information Sediaan Berhad, also known as DARE, highlighted survey findings from the Malaysian Vapers Alliance, or MVA, which showed that 74% of respondents believe a ban would drive illegal sales, while 80% worry it would flood the market with unsafe and unregulated products. DARE Managing Director Pankaj Kumar argued that prohibitions has historically failed as a policy tool, whether in alcohol, tobacco or vaping, and instead creates loopholes that empower the black market. He said Malaysia is already losing billions in revenue while legitimate businesses shrink and jobs vanish, stressing that the solution lies in law enforcement rather than prohibition of products that are already widely counterfeited. Now, the vape industry, once valued at about 3.48 billion ringgit and supporting more than 31,500 jobs, has seen a drastic contraction following regulatory changes. Ministry of Health data revealed that the number of registered brands plummeted from 3,200 to just 390 in under a year since the Control of Smoking Products for Public Health Act 2024 came into force. Now, Pankaj said that this decline was not due to failing demand or falling demand, but to legal loopholes between federal and state levels that have allowed the illicit nicotine market to thrive. Consumers, he noted, are being pushed into unregulated markets where products are untaxed, unsafe and outside government oversight, a direct economic loss to Malaysia. Now, DARE emphasized that Act 852 already provides a comprehensive national regulatory framework with strict safeguards to protect minors. It argued that the logical path forward is to enforce existing laws consistently rather than impose bans that would only deepen black market activity. Pankaj also added that every 1 ringgit spent in the illegal market is 1 ringgit lost to legitimate Malaysian businesses and the government, warning that prohibition would only magnify this leakage. What the economy urgently needs, he stressed, is regulatory certainty and strict enforcement, not bans, that risk hollowing out a once thriving industry. And that is a wrap for the closing bell updates with me, Wan Izul Islam. Thank you so much, investors, for listening in on us. We'll catch you again next week. Have a wonderful weekend. Thank goodness it's Friday. Stay safe out there. For anyone who's traveling, drive safe on the road. And it's about to rain now in the city of Kuala Lumpur, so be wary. Don't drive too fast. Have a wonderful weekend. Thank you so much and have a good one.